Hello and thank you for joining me for the next Bell Direct reporting season video and our last of the Wednesday midweek videos this August reporting season. I'm Grady Wolf, Senior Market Analyst with Bell Direct. Well, so far this reporting season, as we hit the pointy end of the key earnings period, we have seen 178 companies report, with 34 beating expectations, 87 meeting expectations, and 57 missing expectations. In total, 31 companies have been upgraded by brokers, while 43 have been downgraded, signalling more expectations were not met from a broker's perspective, or valuations became stretched on results being released and outlook doesn't match valuations. Let's dive into the key results that move markets this week, early in the week, and what themes continue emerging this reporting season. The Aussie housing crisis and rising pressure from increased immigration numbers fueled strong tailwinds for property developer Cedar Woods Properties, ASX CWP, in FY25, as results out of the company beat consensus expectations. FY25 started on a very strong note, underpinned by $660 million in pre-sale contracts for the company and backed up with a national pipeline of more than 9,400 dwellings, lots and offices, with capacity to make further acquisitions and grow earnings even further. The highlights of FY25 for Cedar Woods on a financial front included EPS rising 19% year on year to 58.4 cents per share versus Bell Potter's expectations of 56.5 cents per share, so they beat on that metric. While DPS, or dividends per share, increased 16% to 29 cents per share. FY26 guidance targets around 10% NPAT growth, slightly ahead of both Bell Potter expectations and consensus, and viewed as conservative given management's consistent track record of exceeding guidance. Key operational metrics were solid, including 1,125 lot settlements, $660 million in pre-sales, and a development margin of 28%. The pipeline also remains robust at 9,419 lots. Net tangible assets for Cedar Woods grew to $5.92, though gearing rose to 25.7%. CWP continues to look attractive at 11.7 times FY26 earnings valuation, below its peers and its own 5-year average, with a 4.3% fully franked yield. Bell Potter maintains a buy rating with an $8 price target, and FY26 looks exciting for investors as the company maintains its focus on strategic acquisitions and strong financial foundations. Of Australia's supermarket duopoly, Coles Group, ASX COL, was the first to report this week, with Woolworths results out on Wednesday, to be covered later in a video later this week, and it wasn't as good for Woolworths. Coles reported FY25 results slightly ahead of expectations, with total sales rising 1.8% to $44.49 billion, and that was driven by strong performance in its supermarket division, which alone delivered $40 billion in sales, up 4.3% on a normalised basis, and beating market forecasts. Excluding tobacco, sales rose 5.7%, highlighting growth in everyday items amid successful value campaigns and a focus on deeper promotions. Group EBIT rose 1.7% to $2.08 billion, and while reported net profit fell 3.5% to $1.079 billion due to significant items, underlying profit actually increased 3.1% to $1.18 billion. A final dividend of 32 cents per share was also maintained. Looking ahead to FY26, Coles is expected to benefit from continued volume growth, stable inflation, around 3% annually for Q4 FY25 on the supermarket basis, and consumer response to its value-led strategy despite headwinds from declining tobacco sales. Endeavour Group, ASX EDV, fell over 1% on results being released earlier this week as the Woolworths demerged alcohol and hotels division faced mounting headwinds on consumer preference and spend fronts in FY25. Endeavour Group's FY25 results show continued weakness in its retail segment, with sales down 1.2% for the year and a further 1.3% decline in the first 7 weeks of FY26, missing guidance and underperforming peers like Metcash, JB Hi-Fi and Super Retail Group. Despite solid growth in its hotels division, up 5% in 2H25, increased reliance on gaming revenue, now nearly 7% of group sales, which raised concerns amid ongoing ongoing regulatory scrutiny. While the Victoria DC disruption has eased, the company appears to have struggled to regain lost customers. Leverage remains above target at 3.6 times, though, deferring part of the One Endeavour program offers short-term balance sheet relief. Slight downgrades to FY26 and 27 earnings forecast, coupled with a reduced target price, contributed to the modest share price decline for Endeavour Group. Aussie Broadband, ASX, ABB, share price surged 20% following the release of strong FY25 results, with revenue rising 18.7% to $1.18 billion, and a 14.7% increase in underlying EBITDA was reported to $138.2 million, which exceeded guidance. The company reported a 24.5% boost in net profit, driven by higher broadband connections, expanded wholesale partnerships, and new business clients. Looking ahead, Aussie Broadband expects FY26 underlying EBITDA to grow 14 to 21%, with a forecast range of $157 million to $167 million. Additionally, the company secured a 6-year NBN agreement with Moore and Tangerine, expected to deliver $12 million in annualized EBITDA from FY27, and sold its Buddy Telco brand to Tangerine, eliminating a drag on earnings and enhancing future profitability. Reece Plumbing, ASX, RCE, FY25 results were disappointing though, with a 1% decline in sales to $8.9 billion and a 20% drop in EBIT to $548 million. Now, that's leading to a 16% share price fall on the day results were released. The poor performance was primarily driven by weak housing markets in both Australia and the US, exacerbated by high long-term mortgage rates in the US that stalled the housing market and renovation activity. Additionally, the company faced intense competition in the US from lower-cost rivals like STA Line, which further eroded market share. Despite efforts to turn around the US business, the outlook remains quite bleak, with no quick recovery expected. Australia's market also showed signs of weakness, especially in Victoria, amid ongoing challenges related to the remote working from home, which have hindered innovation. This combination of market pressures, internal setbacks, and rising competition led to the company's worst performance in history, prompting a cautious outlook for FY26. So, what are the key themes emerging and driving the outlook for FY26 this reporting season so far? Staple stocks have experienced low single-digit growth, but NPAT was hit by elevated promotional activity in FY25, something to watch in FY26. The housing crisis in Australia is driving tailwinds for property developers heading into the new financial year, with strong earnings growth potential amid a solid pipeline of developments. Sale of underperforming assets during FY25 has set a strong balance sheet foundations for many companies heading into the new financial year. Tariffs and weak market condition headwinds are hurting the outlook for growth in many key regions, for many companies are currently undertaking expansion strategies into the US. And that is all for this midweek reporting season video. We look forward to sharing further results out later in the week in our weekly wrap, and we wrap up this reporting season. Have a wonderful day, and as always, happy investing.